Hello again, WSU Vancouver VITA volunteers. This week we are going to be discussing Earned Income Tax Credit. Now, just as a reminder of where we've been, we started the return with all the personal information. We figured out the filing status and dependencies, and we started collecting income, and then we took some adjustments out of that income to get to our adjusted gross income. And then we started looking at deductions, and we took the deductions out of income to get to our taxable income. And then from the taxable income, we figured out our regular tax. And we also added in some special kinds of taxes if they were necessary, mostly like self-employment kinds of taxes that make up for the Social Security and Medicare taxes that might not have been collected. We took from that final tax amount, we were able to calculate some credits that maybe our taxpayers were qualifying for, some non-refundable credits, and we put that towards their tax liability. And if you remember, those credits could lower that tax liability down to zero, but not beyond. And then we talked a little bit about payments, where if we have employees and they are paying as they go towards their tax liability, we talked about where to put that on the return. We also talked a little bit about some of our credits were kind of hybrid credits. They were partially non-refundable and partially refundable. Well, the Earned Income Tax Credit is a credit that is actually fully refundable, so it's a very valuable credit. So let's get started talking more about it. So I know I gave you a sneak peek on the last slide, but just as a basic introduction to the Earned Income Tax Credit, it can be shortened to EIC or EITC. A lot of times you'll see that. Basic definition is that it's a refundable tax credit for most people who work but do not earn high incomes. And its purpose is to reduce the tax burden on these individuals and families, and to also supplement their wages. And then we've discussed this a little bit in the past with some of our hybrid credits, but just a reminder that refundable credits are a type of credit that even if the taxpayer's tax liability is reduced down to zero, they can still receive a refund of the excess credit. So kind of our steps are the calculated credit, and then we compare that to the tax liability. It reduces that tax liability down to zero, and then if we haven't used up all of that calculated credit, our taxpayers are still going to get the full amount of that calculated credit back. As the name implies, the Earned Income Tax Credit is a tax credit that's calculated based on a taxpayer's earned income. And if you remember, we talked a little bit about the differences between earned income and unearned income. Earned income is any income received for work, such as wages, or it could be business income. So for purposes of the Earned Income Tax Credit, our earned income items might be wages, salaries, or tips. It could be union strike benefits are also considered earned income. Long-term disability if the taxpayer is under the minimum retirement age. So if you remember, this is our taxpayer that's getting a 1099-R that ordinarily is for retirement, but if they have a code 3 in box 7, that means it's a disability payment, and if they are under the minimum retirement age as determined by the place that was employing them, then they get to count this as earned income, and it would get reported on line 1 of the 1040. And there's a little checkbox in TaxSlayer on the 1099-R screen that says to move this amount over to line 1 of the 1040. So that is also considered earned income. Net earnings from self-employment. So this is not something necessarily you will see if you are certifying as a basic volunteer, but if you are certifying at the advanced level, then you might be able to see some net earnings from self-employment, and those count as earned income for the earned income tax credit. Household employee income, non-taxable combat pay, and non-employee compensation. Those are all considered earned income. So let's review what is unearned income. So interest and dividends, we talked about that before. Social Security and railroad retirement benefits are not considered earned income. Pensions and annuities, so this is our 1099-Rs under normal circumstances, so not code 3 in box 7, some other code. Welfare benefits, which we haven't discussed before, are considered unearned income. Veterans benefits are also unearned income and can't be used towards the earned income tax credit. Alimony and child support, and as we've discussed before, unemployment compensation are not sources of earned income, so those cannot be used towards the earned income tax credit. And there's another chart of this in our publication 4012, tab I. So, you know, if you are in the moment with a client and you can't remember whether this type of income would be earned or unearned, it's okay, you can always look it up. I should also make a note that TaxSlayer really does these calculations for us. So as long as we are entering income items correctly, TaxSlayer will correctly figure what is earned versus unearned. The biggest one that might get missed is probably going to be that long-term disability, just making sure that you're catching any code 3s in box 7 on 1099-Rs. But other than that, the reason why we're looking at this is really because sometimes we will have clients that are used to getting a certain amount of earned income tax credit in prior years, and maybe they're not getting that amount this year, and so we need to be able to be prepared to answer questions as to why that might be. So one possible thing that could affect this would be if they had wages in a previous year and unemployment in the current year, then they would be seeing a reduced amount of earned income, which would reduce the amount of their earned income tax credit. And I just wanted to give you an overview of the effects of income on earned income credit. So this is a credit that it gets bigger the more earned income that a client has, and the more children that a client has, the more credit they are entitled to. But after we reach a certain plateau, and as earned income increases and AGI increases, then the amount of the credit starts to taper off. So that's why you see these humps going up and then tapering off. And it's kind of a good idea just to have that, you know, around $60,000 in mind for earned income, because any taxpayers with incomes over that amount are just not going to qualify for the earned income tax credit. So having a rough idea of where these income limits apply is just helpful as a rule of thumb, again, as we might be explaining to our taxpayers why, last year they received a credit and this year they don't receive as much, or they don't receive the credit at all. And as we talked about, TaxSlayer does these calculations for us, but this is where how the earned income tax credit gets calculated. The IRS puts out these tables. Notice that this is not the tax table, it's a different table. But you can see there on the left that there's, kind of an income bracket. And then there are some filing statuses across the top, and inside of those filing statuses it has a number of 0 to 3, and that's how many dependents this taxpayer has. And so that's how the credit is figured, based on the earned income, the filing status, and the number of dependents. Now we do have a special rule for earned income credit for 2021, and that's that taxpayers can choose to figure the earned income tax credit using their 2019 income, as long as that income was higher than their 2021 income. So this is something we might want to be on the lookout for. It may give them a larger credit. As I was talking about before, you might have a taxpayer who was, employed in 2019 and was receiving earned income, but in the time since they've been unemployed, and so now they're receiving unemployment compensation, which doesn't count towards this credit. Well, you may be able to help them understand that they can choose to use their 2019 income, and that would increase this credit. So aside from calculating from earned income, we do have some eligibility requirements, and there's 3 main groups, or a group that's everyone and 2 other groups that have certain requirements. So this little chart comes from our publication 4012 tab I, so it's again a super handy resource. The rules for everybody are that the taxpayers and any qualifying children that they're trying to use towards this credit have to have a Social Security number that is valid for employment, and that's by the due date of the tax return. So it's important to note that valid for employment. Some individuals might have a Social Security number that or a Social Security card that is stamped saying that it's not valid for employment. If that's the case, then they won't qualify for this credit. So it has to be valid for employment. Their filing status can't be married filing separate unless they meet that exception for spouses living apart, which in that case, they're usually not filing separate, they're filing as head of household. As per usual, married filing separate status really limits the tax benefits that a taxpayer can claim. So this is one of those limits. The taxpayer must be a U.S. citizen or a resident alien for the entire year, and they can't be filing Form 2555, which relates to foreign earned income. I don't think we're going to see a lot of that, and for our basic preparers, we shouldn't be seeing that because it would be out of scope. And then in addition to those things, the investment income for this taxpayer or this family must be $10,000 or less. The purpose of the credit is to help working families to supplement their wages, right? So if this is a family that has low wages, but they're getting a lot of investment income, it kind of defeats the purpose of the credit. So that's why the investment income is limited. And then the person who is claiming this credit can't be a qualifying child of another person. So moving on now to our specific requirements for our taxpayers who are using a qualifying child to calculate this credit. So this child that they're using for the credit must meet the relationship test, the age, residency test, and joint return tests, but they don't need to meet the support test. And the child does not have to be the taxpayer's dependent. We'll talk a little bit more about this in a coming slide. The qualifying child can't be used by more than one person to claim earned income credit. And the taxpayer cannot be a qualifying child of another person. Rules that are specifically for people who are claiming this that don't have a qualifying child. The taxpayer must be at least age 19. So this is a different thing for this year. It used to be age 24, but they've since lowered it, so now it's 19. The taxpayer can't be a dependent of another person. They need to have lived in the United States for more than half the year. And again, they cannot be the qualifying child of another person. And then I'll just draw your attention down to Part D, where we have the earned income and AGI limitations for the credit. So there again is another resource if you just kind of look this over and have in mind some of these limits. You can see that if a taxpayer does not have a qualifying child, the earned income limit is quite low. It's $21,000. If they're married filing joint, it's a little closer to 30. But without a qualifying child, our taxpayers are going to get phased out quite quickly. And then it increases if they have one qualifying child, increases again 2, and it increases again if there's 3 or more. But again, around the $60,000 range, we're not going to see people qualifying for this credit anymore. And here are some interview flows from our publication 4012 tab I for each of those different types of taxpayers that are trying to claim the credit. So again, we have a flow for our general eligibility rules, our rules for claiming with a qualifying child, and our rules for claiming without. So a resource that's available. As promised, we'll dig in a little bit more into what it means to be a qualifying child for earned income credit. We saw before that there's still the relationship test. This is the same as it is for a qualifying child for dependency. The child needs to be a son, a daughter, a stepchild, foster child. It can be a brother, a sister, a half-sibling, step-sibling, or a descendant of any of them, so nieces and nephews. And the age requirement is the same as for dependency, so younger than the taxpayer and under the age of 19 or under the age of 24 and a full-time student. Residency is similar, but it's a little extra restricted. So the child needs to have lived with the taxpayer over half the year in the United States. So if you remember, for dependency, the child could have lived in Canada or Mexico and still be a dependent. However, for earned income credit, it needs to be residing in the United States. As with dependency, remember, temporary absences don't disqualify the child from being claimed. So the big one for that is college. The support test is not part of qualifying child for EIC, but in addition to the 4 major tests there, the child must have a Social Security number in order to qualify for earned income credit. So if we have a family come in and some of the children have ITINs and some have Social Security numbers, then only children with Social Security numbers can be qualifying children towards this credit. The child does not have to be the taxpayer's dependent. So this is something that we think of in cases where parents are divorced or separated, and We have the custodial parent whom the child lives with, and then we also have a non-custodial parent, and according to the divorce decree, that non-custodial parent gets the dependency of that child so that they can claim the child tax credit in maybe alternating years. The important thing to remember is that while that non-custodial parent can claim the child tax credit, the earned income credit stays with the custodial parent. So even if that child is not a dependent on the custodial parent's return in that year, they can still use that child as a qualifying child for earned income credit. And it's really important to note that only one person can claim that child for EIC. So sometimes we have multi-generational homes where a parent could claim the child or a grandparent could claim the child. Only one of them is going to get to claim the child, and only one of them is going to get to use the child for earned income credit. And let's look a little bit more at how that works out in cases of split parents and multi-generational homes. This might look familiar from one of our previous lessons when we were talking about dependents. This is when a qualifying child qualifies for more than one person. And just like with dependency, we run into some tiebreaker rules when you have parents who are maybe separated or divorced or multi-generational homes. So if we remember, if the parent or the parents filing jointly claim the child and somebody else tries to claim the child, it's the right of the parents to claim their child first. So that counts for the dependency. It also counts for EIC. If it's between two parents, then it goes to the parent who the child lived with longest. Again, in other terms, that would be the custodial parent. If in the off chance the child lived with parents 50-50 for the year, then the dependency and the ability to claim this child for EIC would go to the parent with the highest adjusted gross income. And there are certain situations where no parent can claim the child. Maybe the child didn't live with the parent at all, and the parent wasn't supporting that child. Then it would go to whatever person is that child is living with the highest AGI. And then again, there are cases where a parent may choose not to claim the child, and then it would be the person for whom that child is a qualifying child that has the highest adjusted gross income if it is higher than the parents. And this is often that multi-generational situation where you have a grandchild and the parent and the grandparent all living under the same roof. The grandchild is a qualifying child of both their parent and the grandparent, and perhaps the parent is not making any money, or they are making very low amount of money. Then it might be possible for the grandparent to claim that child if the parent allows the grandparent to do that, and then the grandparent would also be able to claim EIC as long as all other requirements are met. And then we can just look at the flow of the forms. Again, TaxSlayer is going to be calculating the amount of the earned income credit so long as we have done our dependency entries correctly and our earned income entries correctly. Then we don't have to worry so much about the calculation. However, again, sometimes we have taxpayers come in and get a different earned income credit than what they've gotten in the past, and they want to know why. So it's important to be familiar with where these forms are and how they flow onto the return and how they affect EIC. So we have our Schedule EIC, and this is for taxpayers who are claiming the earned income credit based on one or more qualifying children. And so the children would appear here on this Schedule EIC. You can see that here in the top part we have the child's name, child's social security number. So you know, you can look at this form and make sure that all the children are there. Do they all have social security numbers? If they don't, then we're able to explain, oh, well, you know, this one child doesn't have a social security number, they have an ITIN, and unfortunately that doesn't count. So then we also have the EIC worksheet, and this goes through all of those general questions that can qualify or disqualify a taxpayer for claiming the earned income credit. And this and the Schedule EIC you'll pull up when you pull up the PDF preview of the return and tax layer, and usually they're towards the end, so you scroll all the way to the end and you can look and see, you know, what boxes are checked, what boxes are not checked, and that can help you determine if something in the return needs to be changed, a checkbox needs to be checked, or something was put in the wrong place, or if we just need to have that conversation with the taxpayer about why they did or did not qualify for the amount that they are getting or expect to get. And here is where the earned income credit flows on to the 1040, onto page 2. As you can see, we're working our way down page 2. So we've already calculated our total tax, and we put our other payments towards that total tax, and then we get to calculate the earned income credit and put that towards the tax. And you can see there's a little bubble there that, you know, if you have a qualifying child attached, Schedule EIC, which we just looked at. Now, it is possible that earned income credit can be disallowed. So if earned income credit was disallowed in a prior year, it's really important that we are making sure that our taxpayers are getting their returns filed properly. And there's a question about this on our intake form, Form 13614C, down in Part 5 under Life Events. Question 4 is, did you have earned income credit, child tax credit, or the American Opportunity Credit disallowed in a prior year? And if yes, for which tax year? Now, a lot of times our clients will come in and they will mark unsure, or they will leave this blank. Sometimes they'll mark yes, but they weren't sure what it meant. So it's important to discuss this with the taxpayer, and if they aren't sure, let them know that they would have received a letter from the IRS with either an adjusted amount for the earned income credit or a letter saying that it was disallowed, and they would have had to pay some of that credit back. So this is not something that that happens and somebody just forgets about it under normal circumstances. It's a big enough event that that they are going to remember what happened. So for our taxpayers that are like unsure and they're worried about doing the wrong thing, you can assure them that if this had happened, they would remember it. They would have gotten that letter from the IRS and they would have had to pay back some of the credit, or all of it. If indeed they had EIC disallowed in that prior year, then Form 8862 is a form that can be filled out to help them begin to claim the credit again. But if the disallowance was due to a reckless or an intentional disregard of the rules, so this is not like a math error or a clerical error, the taxpayer is not going to be able to fill this form out and begin claiming the credit again for 2 tax years after the disallowance. And if this disallowance was due to fraud, they will not be able to claim the credit for the next 10 tax years. So there's more information about this and about how to enter this into TaxSlayer in Publication 4012 Tab I. It's not a very common occurrence in my experience anyway, but if it does come up, you can look in your Publication 4012 and it will help guide you through getting everything entered correctly. So now that we've discussed the earned income credit, how it's a refundable credit that is based on earned income, and we talked about the effects of that earned income on the tax credit. So as earned income increases, so does the credit, but after earned income reaches a certain amount, the credit plateaus and then it begins to taper off till eventually around $60,000 in income or AGI. We won't see our taxpayers being able to claim this credit anymore. We talked a little bit about some of the special rules for qualifying children that help increase this credit. And we talked about that TaxSlayer really does these calculations for us, that we're learning so that we can discuss this with our taxpayers if they have questions, which do come up regarding how much they expected to get and how much they are getting. So now that we've discussed all that, you can head on over to Link and Learn and answer the skills check questions. There's only 4 of them. TaxSlayer, again, there's no entries needed because TaxSlayer does these calculations. Remember our resources. We have Publication 4012 and Publication 4491. They are available during the tax season and they are available during the open book certification exams.